silver spent above $40. And that this is monthly data. So that spike actually goes much further down to the bottom of the chart than what you're seeing here. This is monthly data, not daily. And then on top of that, back in 1980, when we had that spike, there was a lot of above ground silver. There were enormous government stockpiles still. The economy wasn't in trouble. Like I said, debt to GDP and all of those fundamentals. And we didn't have the entire world is about to rush into the precious metals to protect. Like in China, it's already happening. The West, for some reason, has been totally asleep. And it's really too bad that people weren't jumping on gold a couple of months ago before the last big rise. It's really too bad that people weren't jumping on silver back when it was $20 instead of, $47. This is basically house price inverted because it's in gold. So gold's maximum purchasing power, and the home is super cheap when it goes down to the bottom. And we looked at this a little bit and discussed it before the video here. And you looked very closely at this, and it looks like there's about 12 data points per year. And so this is a monthly chart, putting the peak of gold at around $600 or $650, not $850. So that spike at the bottom at 1980, where homes become super cheap measured in gold, actually goes much lower than what it's showing, probably down to 50 or below, right?
Yeah, I would think so. Yeah, I'd have to do some more math around it. But yeah, absolutely. So what gold holders should expect is that their purchasing power might continue to double to approximately meet, the purchasing power back in 1980, measured in houses. So absolutely,
right.
However many houses you can afford now, you should be able to afford twice as many if you keep holding gold.
Yeah, except I do want to say that it should probably go down to that area if we had 33% debt to GDP like we did in 1980.
Delving deeper, at the peak of gold's purchasing power around 1980, it took perhaps 80 ounces of gold to buy a median home. Later, when housing soared in dollar terms, the ratio climbed dramatically. Real estate became costly relative to gold. Today, the number of gold ounces required to buy a house is considerably below earlier highs, highlighting an opportunity. If gold holds its value and houses soften in dollar terms, gold owners may benefit.
If the stock markets were super undervalued like they were in 1980 with PE ratios of like 7, 8, 9, 10, where a brand new bull market is just forming instead of one that is hyper overvalued and overextended and about to crash. This time, I believe that we're going to blow way past that 1980 spike down on the bottom. So when you're looking at the value of your gold compared to real estate, you sort of, in your mind, have to flip this chart upside down. Those are the gains in value that your gold is making against real estate. This is how cheap a house is becoming if you're owning gold. So, yeah.
Exactly.
Any other comments on that?
Yeah, no, I think you said it. And basically, this is about the purchase price of the house. I also want to look at the monthly payment that you'd expect to make, because I did that calculation a few months ago. I just want to remind our audience, or maybe show people for the first time if they're new to the channel. What you see here in the red line, let's look at the red line. This is the monthly payment you'd have in dollars, okay? And this is taking the median sales price of a home in the US and the 30-year fixed rate that people are paying nationally, and basically calculating what that monthly mortgage payment would be. And that's the red line. And you can see it rose a lot in the 70s after we unpegged the dollar from gold. And then it rose a lot right after 2020, basically when fractional reserve lending completely disappeared and infinite cash could be created. So things are getting out of hand. However, when you measure it in gold, it used to be 3 or 4 ounces of gold per month, and now it's down here below 1 ounce of gold per month and getting cheaper. So again, we see the same story playing out. If you're paying in dollars, things are getting more and more expensive. If you're paying in gold, things get cheaper.
Beyond purchase price lies financing. the monthly mortgage payment. When denominated in dollars, payments have skyrocketed post-2020 due to tighter credit, higher rates, and inflation. But when measured in ounces of gold, the story flips. Monthly payments now require fewer ounces than in past decades. The implication for someone holding gold, servicing a home loan may become relatively easier than for others paying in fiat currency. This duality, dollar payments up, gold payment burden down, underscores the shifting landscape for homeowners and precious metals investors alike.
Yeah, I do want to point out for everybody that you made this chart a few months ago, you said.
Yep.
And so it's before gold rose from like $3,300 up to $3,800.
Yeah.
And so it doesn't have that data in it. And that means that that yellow line just fell below we're probably at like less than about half an ounce of gold now, something like that for a mortgage payment. And so, it just shows you that, throughout the centuries, period, throughout human history, gold protects your purchasing power. And right now we're in one of these cycles where the safe haven asset becomes the asset class with the maximum potential gains in purchasing power. So these are rare moments in history, very rare.
Absolutely. Absolutely. And it's not just gold, it's also silver. So let's look at home prices measured in silver. How many ounces of silver would it take to buy a house? Right now, it's about 10,000 ounces of silver. But in the past, it's been as little as maybe 2,000, something like that. So we could see the purchasing power, of silver increase fivefold easily from where it is today. So a lot of gains still left on the table.
Okay. Well, you did a chart recently of how many days silver spent above $40, and that this is monthly data. So that spike actually goes much further down to the bottom of the chart than what you're seeing here. This is monthly data, not daily. And then on top of that, back in 1980, when we had that spike, there was a lot of above ground silver. There were enormous government stockpiles still. The economy wasn't in trouble. Like I said, debt to GDP and all of those fundamentals. And we didn't have the entire world is about to rush into the precious metals to protect. Like in China, it's already happening. The West, for some reason, has been totally asleep. And it's really too bad that people weren't jumping on gold a couple of months ago before the last big rise. It's really too bad that people weren't jumping on silver back when it was $20 instead of, $47.
It's not only gold. Silver enters the narrative as a leveraged alternative. Historically, far more ounces of silver were required to buy a median home compared to gold. In times past, perhaps 2,000 ounces of silver might purchase a home. Today, it might cost 5 times that. The suggestion, if silver's purchasing power improves relative to housing, then silver holders may find a significant upside. Coupled with gold's trend, precious metals broadly could reshape the relationship between money and shelter.
We are about to break that $50 barrier, and it's going to be in the news over and over and over again. And you're going to see this very rapidly, especially if it's coincident with, in 1980, real estate wasn't in a hyper bubble. And it is today. It's in a gigantic bubble. And if silver is going north at the same time that real estate is crashing, we could see a day come where less than half the amount of silver is required to buy a single family median price home versus this chart in 1980. So, this chart says that you probably have 5 times gains. In other words, you could sell a house today, invest in silver, and if you are able to nail the peak, you'd be able to buy 5 homes with the proceeds from your silver. Well, it's probably going to be more like 10. That's my point, because the fundamentals are there this time. So anyway, okay, let's...
Yes, so that could even be 1,000 ounces of silver, right? A 10x move from here is 1,000 ounces of silver. That's 2 monster boxes. A lot of people have 2 monster boxes, so
Yeah. Right.
That's
right.
doable. That's doable.
It is doable.
Yeah. So what I have
Okay,
here,
and it's just math, and then you take what happened before. So it's a repeat of history, adjusted for inflation, and then you add the difference in the underlying fundamentals. Real estate was not in a bubble. The stock markets were way undervalued, and gold and silver went into a hyper bubble. This time, gold and silver are going to go into a hyper bubble.
Context matters. The modern housing market carries signs of excess, high price-to-income ratios, stretched affordability, and rising interest rates. Analysts estimate that to restore housing affordability to recent baseline 2016-19, either home prices must fall by 40%, or household incomes must rise 60%, or mortgage rates must fall to historically low levels. Each scenario seems improbable in the near term, suggesting the imbalance will likely correct through downward price adjustment. That correction could coincide with precious metals' strength, creating pronounced shifts in asset values.
But real estate and stocks and bonds are also in hyper bubbles, the biggest in history. And when those bubbles pop at the same time that gold and silver are going north, you're going to see some amazing priced in gold, priced in silver, fire sale prices on everything. Stocks, bonds, which you probably don't want to touch, and real estate, which you probably want to consume as much as possible. Get fat on real estate.
I can't wait. Our next chart here, renting is now significantly more affordable than buying a home by one of the widest gaps ever recorded. So we can see here,
wow.
Yeah, the dark blue line, the rent to income ratio, and the light blue line is the mortgage payment to income ratio. So you can see that owning a home got significantly more expensive, like twice as expensive, or I'm sorry, it's not a true zero, so it's not twice, but significantly more expensive than renting, and it's happening again now. So that was the same as the global financial crisis. And are we having another crisis?
Now we're way up past the peak of the global, we're way up past the peak right now of the global financial. Well, that wasn't the global financial crisis. That was the peak of the real estate bubble. That's above, it's like 32, I guess, on this chart, or 30, yeah. But we're above that. We're up at like 32. We're up above it just slightly. But the thing is, to be up above the 2006, 2007 real estate bubble that led to the global financial crisis when we weren't in a stock market bubble, this is something amazing and scary at the same time.
Exactly. And if it comes down, what is going to cause it to come down? Like something has to give, right? Something has to crash. Things have to move fairly rapidly to bring back into balance. So we'll see what happens.
Yeah. Okay.
Our next chart here, home prices need to fall 40% or incomes need to rise 60% just to return the housing market to 2019 levels. Generational crisis. So let me elaborate on that by reading this paragraph here.
What does all this mean for you? First, owning gold or silver may offer relative strength if housing and broader asset classes reset. Second, if you're a homeowner or aspiring one, comparing your capital in real assets to gold metal terms offers a unique lens on value. Third, timing matters. Rare moments arise when safe haven assets like gold reach maximum purchasing power, just as other assets are vulnerable. For those with a long horizon, staying alert to these inflection points can yield strategic advantage, whether for preservation, diversification, or opportunity.
According to Fannie Mae calculations, okay, government numbers.
Wow, government agency, basically, one of the government-sponsored entities.
Yeah,
Fannie
but
Mae.
all the government numbers are wrong anyways. No, okay. let's use their numbers.
Right, but when they fudge things, they try and make them look better.
Yeah,
and this thing is sort of bad news for the economy. Go ahead.
Exactly. Let's see how bad they admit that it is, and maybe it's even worse. So, according to them, it would take one of three things, or a combination of them, for affordability, housing affordability, to return to the 2016 to 2019 levels. Okay, here are the three things. Either the median price of a single-family home would need to fall 38%. 38%
Whoa.
to about $250,000. Okay, that would have to happen to make houses affordable. or median household income would have to rise more than 60% to 134,000. I don't see that happening. Or the third thing, the mortgage rate would need to fall to 2.35% from roughly 6.5% where it is today.
Okay, looking at this, this is just an opinion, so take what you will from it. But I feel like the only one that could possibly happen and will most likely happen is that all of the real estate will fall. We are in for a crash because that is what is in a hyper bubble. Right now, incomes are depressed, but if you go into a crisis, and there is one brewing right around the corner, incomes do not rise in a crisis. Unemployment rises. And so I have a feeling it's probably going to be bigger than that 38%. We're going to see something similar to the global financial crisis, but even worse because it isn't just real estate. It's real estate, stocks, and bonds. Okay.
Yeah.
What's your take?
Yeah, no, I agree with you completely. I don't see mortgage rates dropping. Not to that extent anytime soon. I mean, we're just in a 40-year, declining interest rate environment. We're probably entering a 40-year rising interest rate environment. Despite recent rate cuts, it's probably a long-term rising rate environment. I don't see incomes rising. The only way incomes would rise is as a result of like a lot of inflation, like massive currency creation. But then the price of homes would probably go up even more than incomes, which is exactly the crisis we're talking about, right? Home prices are rising faster than incomes. So, gosh.
Yeah, in the previous chart where you were talking about the affordability as far as rent versus or the mortgage payment, I can't remember what the chart was, but you said something has to give, and it's that fall to 38%. Yes, so rent versus income ratio and mortgage payment versus income ratio. Something has to give there. And the only thing that's going to give without the economy getting more screwed up than it is real estate is going to take a giant crash, and it's going to be greater than that 38%.
Yeah,
okay.
I think so too. And how did we get into this mess? Is it because of massive currency creation?